So does this mean that the markets have appropriately priced in an earnings slowdown where things stand right now, with the S&P down 20+% and the NASDAQ off 30-some% from their highs, the record levels that we've seen?
Good morning. Yeah, I think the markets had dropped quite a bit, and we've seen, as your stats had indicated, better than expected so far earnings, and I think this week will show that some more. Unfortunately, I think it's the credit markets that are really driving where equity prices are going. We saw that Friday with the nice rally. It started with a drop in rates, and interest rates and Fed policy have really taken the lead with where the stock market is going. And even if we get better than expected earnings, I think it's going to come back to the Fed and Fed policy and what happens there, and that's going to move stocks going forward.
So there's a fundamental case that we know, Degas, to Eric's point, that interest rates are driving the conversation, that the Fed is very much in control of what's happening with the markets right now with regard to their policy and the down moves that we've seen. But this is a time for a lot of microeconomic, company-specific catalysts. And I showed you the stats. It's generally positive. Why isn't the market reacting more forcefully to the upside? Is interest rate policy still going to be overriding even more so than corporate results?
You know, what we look at is that the Fed is still going to be really leading this market. And so we're seeing that the Fed is going to continue to be aggressively rate hiking because of the growth in the service demand. What we're seeing is that service demand has increased over the last 8 quarters, whereas good demand has slowed down over the last 3 quarters. So we're still seeing the Fed in charge of the market. But the good thing about this, as you mentioned, the corporate earnings is still coming in better than expected, and that's going to help the market. Also, the labor market is still strong. So those two things are positive for the market.
Degas, if I could follow up on that, if things are constructive and positive for the market, are you out there buying right now? Is this a time where you can be bargain shopping for some of these bigger names?
Exactly. Well, it really depends on the client's time horizon. If you have a 3 to 5 year time horizon, this is definitely a good time to buy. However, we had a client that had a current income need that needed money each month, and so we went to short-term duration bonds. We had another client that's going to retire next year, and we moved that client into dividend stocks. So it really depends on the investor and what their time horizon is.
All right. So Eric, if it is up to the investor and their time horizons, it's appropriate. Everybody is different with regard to their risk tolerance. What exactly is the opportunity right now? You mentioned credit. There are some very attractive yields right now in high yield or junk credit, also in investment grade. I mean, is this the time to go into bonds versus stocks?
Yeah, I do. You know, we've had such a big decline in bond prices this year. If you look at the broad aggregate index, it's 17% down, and as he indicated, high yield is down a lot more. So for individuals in high tax brackets or in states with high levels of state income, we really like the municipal market. These are very high credit bonds, and you can find yields, straight yields in the mid 4% range now. When you look in after tax returns, it's much higher. For clients with a higher risk tolerance, absolutely like high yield, like preferred stocks, which give qualified dividends. And for people who don't have a lot of risk, even in short-term treasuries now, you're above 4%, and you don't pay state income tax on that interest. So there is a lot of opportunity in the credit markets.
All right. So Eric likes the credit markets, certain places in high yield. Degas, what are your favorite stocks out there?
Yeah, so we like companies in healthcare. For instance, Regeneron. It invests about 18% of research and development of revenues, and they're doing an outstanding job of building that portfolio of drugs, such as Eylea, it's an eye treatment, Dupixent, which treats asthma, and so we see companies like Regeneron doing well. We also see companies such as the Enterprise Products Partners doing exceptionally well. That's a pipeline company. And the good thing about that is that they have 80% of long-term contracts. So they're going to be able to escalate their prices and not be really tied to commodities. And then, lastly, we look at companies on a global basis also.